about interest rates, what's going to happen with the real estate market. And here at Describe TV and Actual Human, we've actually made some predictions about interest rates. What's going to happen? What's going to happen to the market? A lot of people are waiting for interest rates to go down or the housing market to crash. And as you know, we've talked about it's a pretty big risk to wait for that because the signs pointed to the fact that interest rates aren't going to go down. It might keep going up. And even a few months ago, we talked about maybe going over 8 into the 9s, and that seemed crazy back then. We're going to talk about where some of the developments are showing exactly what is going to happen. There's no more guesses. There's no more speculation about interest rates and the housing market. We're also going to talk about what's happening with electric vehicles. There may be things happening with electric vehicles that right now don't think they're going to affect you because maybe you don't have an electric vehicle. Maybe you don't want an electric vehicle, but you need to know what's happening with electric vehicles because regardless of what your opinion or your plans are for electric vehicles, these things are going to affect you significantly. There's also some behind the scenes hidden activity in the cyber security field. Cyber attacks are happening, and they're now starting to affect consumers as much as they are affecting businesses. And we'll talk about that. But first, we're going to take a quick little replay on a subject that was in the front of the news for many weeks, and that's the Lahaina fire. And you've probably seen where it's died down quite a bit. You don't see a lot of news about it anymore. What's going on with the Lahaina fire? Well, who knows? There's a lot of conspiracy theories, how it started, why they did it. Are they trying to take over the land to build resorts? Right? Is Oprah wanting to take over the town? I mean, there's all kind of crazy stories. But not to say this is exactly what's happening, but let's take a look at another event in history which happened in the complete other side of the country. Hawaii is about, and Maui is about as far west as you can get in the US. If you go all the way to the east, there's another luxury location called Palm Beach, Florida. And I'm not talking about West Palm Beach. I'm talking about Palm Beach Island. Palm Beach Island is a small strip of land off the coast of Florida. You know, there's a bridge that connects West Palm Beach to Palm Beach. The two could not be more different. West Palm Beach has some poverty. There's a little downtown area with commercial buildings, but once you go over the bridge onto Palm Beach Island, it couldn't be more different. There are houses that are hundreds of millions of dollars. It's almost impossible to find a house under 10 million. Most houses are 10, 12, 15, 20 million. There's a resort there called the Breakers. The Breakers charges $1,000 a night for rooms. Some of the properties there have a tax bill of millions of dollars per year for property tax, not what the house is worth, not what the value is, but what the owner pays for tax. At the end of every year, the owners pay a bill, writes a check for $2 million for taxes. So all that money is going to the town, to the county. So the reason I'm saying that, planting the seeds for a story, is back 100 years ago on Palm Beach, there was a development called the Sticks. And this is what it looked like. A lot of wooden shacks, a lot of wooden shanties. And this was a black settlement. Most of Palm Beach Island was being developed by a person named Henry Flagler. And Henry Flagler, to his credit, did a lot of development. He built a railroad from all the way down the East Coast, from New York to Palm Beach, and actually made it all the way down to Key West. And that's what made Florida happen, because prior to that, there were no roads that went to Florida. Most of Florida was swamp, so you couldn't even drive across it. This railroad allowed a lot of the sophisticated, wealthy people from New York and New Jersey and the Northeast to come down to Florida in the winter to warm up, basically. And that development, or that railroad, allowed development. But what happened was, in the early 1890s, the Sticks was this shanty town. And it was right on the beach, right on the coast in Palm Beach Island. And the reason that it was there was because all these black workers were what was being used to build the railroad and build this development called the Poinciana. Hotel, which was the luxury hotel where people went from New England. An estimated 2,000 African Americans work at the island's hotels, estates, and golf courses. It was black laborers and their families they hired. They put in ads in the Philadelphia, and they came down by the boat from Jacksonville. And they were ripped off on their work, on their labor. Workers were not always paid right away, right? Big surprise, right? So what happened? As the town grew, they needed more room to build some luxury homes, right? And these black labor force needed a place to live, so they created a tent settlement off North County Road. They called it the Sticks because of its remote locale. There was no running water, and sewage piled up, but it was close to the hotels and a cheap option. But at some point, the white powers that be decided it was an eyesore, had to go. Newspaper clippings from the 1900s showed an effort by local businesses to have the tent city closed on sanitary grounds, eviction notices. But here's the legend of what happened. Flagler's henchmen burned out anyone who didn't budge. As the story goes, he brought a carnival to town, provided free tickets to all of his black employees, and it emptied out the Sticks. When the residents returned, their homes were burned to the ground. That's the accepted account for many in Palm Beach. Now, the reason that this rang a bell with me, because for many years I lived on Palm Beach. I had an office on Palm Beach Island. And the building that I had my office in had a hallway where, the different offices were. And there was a picture of the Sticks, kind of like the one that I first showed you with the wooden buildings. And a lot of the people that worked in this office were older. Some of them were attorneys. And they told me about this story. And when the Lahaina fire happened, I'm thinking, man, it's not exactly the same thing, but maybe it wasn't intentional. More importantly, is the same thing going to happen? Because to fast forward the story and give you the punchline, when the Sticks was burnt out, they didn't rebuild wooden shanty shacks afterwards. What they rebuilt was multi-million-dollar homes, which now are paying millions of dollars, hundreds of millions of dollars in taxes. So it actually worked out okay for Palm Beach and the government. So the question will be, watch what happens in Lahaina to see, are they going to rebuild workforce housing for people that are native, that live there, that's their generational lifestyle, or are they going to rebuild a resort? Whether or not the fire was intentional or was a conspiracy, let's not even get into that, because nobody's going to know the answers to those questions. Because even if it was, they're going to keep it a secret. But what do they do afterwards? And that's going to be the big question. So I know I got off on a little bit of a tangent before we get into our main subjects, which is what people love to talk about. Let's talk about mortgages. So here's the deal. Mortgage rates top 7% for the 6th straight week, but it could go higher, right? How does that work? Well, for the last year, when rates were going from 5 to 6 to 6.5, people thought, oh, it's too high. The rates have to come down. Well, I always said, why do they have to come down? What makes 6% high? What makes 7% high? What makes even 8% high? Historically, those rates were seen as normal many times over the last 20 years. Now, it's high compared to what it was in 2019 or 20, but it's not high compared to historical. The other thing that makes it seem like it's high is what it turns into for a mortgage payment. If your mortgage payment at 7% is crazy high, $2,000, $3,000, $4,000 a month, then yeah, the mortgage rate seems high. But part of it is the mortgage rate. Part of it is the price of a house too. So everybody thought, well, the rates are going to go down. Well, that was when this was September 21st, which is recently. But what are they saying now? Higher interest rates not just for now, but maybe forever. Rate projections suggest Fed officials see a rising neutral rate, which is the normal rate, what it's supposed to be. Federal Reserve officials surprise markets by signaling interest rates won't fall as much as planned. Well, there you go. People were thinking the rates are going to fall. Now they're saying, no, this is normal. rates might be higher, not just for longer, but forever. In more technical terms, the so-called neutral rate, which keeps inflation and unemployment stable, has risen. So, like we said before, our prediction is that rates are going to be just over 8, 8.2, 8.1, 8.3 over the next 6 to 8 months. There'll probably be another little spike in 2025 where they get right around 9. After that, the future is harder to see. They could go up even further. You look in the 80s, rates were 12, 14, 15%. That could happen again. Or they might come back down. The problem is it's very difficult to see an economy and a business model for lenders where rates in the 5s is sustainable, or even 6s. If you have an interest rate at 6%, that means the Federal Reserve has to be giving away money at like 2% or 1.5%. They can't do that because it costs them more to produce that money. They did it for a while in the 2010 decade because they wanted to pump up the economy. So they lost some money on purpose. Can't do that anymore. At the same time, mortgage companies, mortgage lenders who have to mark up that rate used to have to mark it up maybe 3%, 2 to 3%. So if you were getting money for free or 1%, you could lend it out at 2 or 3. Now, the cost of issuing mortgages and the cost of originating mortgages is higher. There's less mortgage companies, more regulation, less mortgages going out for approval to begin with because less people are buying homes. So they have to actually have a higher margin, higher padding. So if the Federal Reserve rate is, let's say, 5 or 6, instead of marking up 3 or 4%, you might have to mark it up 5% in order to stay in business as a mortgage company. So now you're going to be at 10 or 11. It's very possible that happens. Mark this video and put it on your calendar for February of 2025 to see what the rates are and see if it's in that range. See if it's in that 9 or 10% range, which is very possible. Again, we're not predicting things. We're just projecting based on what might be happening. How does that affect the real estate market? Well, here's the thing. Weekly mortgage rate demand increases. Even there's a surge in financing, even with the rates going up. Why is that? This is troubling. Applications to refinance a home jumped 13%. Think about this. Rates are going up and people are refinancing. Why would somebody refinance at a higher rate? What is the motivation for refinancing at a higher rate? These aren't purchases because purchases only increased 2%. Refinance increased 13%. So why would somebody refinance a mortgage if the rates are higher? Because look, if the rates right now are 7.2%, 7.3% maybe, nobody in the world has a rate that high on their house right now. Many people have 3 or 4%. Some people have 5. You would have to go back 30 years, 25 years to have rates that high, and nobody has a mortgage that long. So what's the reason for this? This is probably the most troubling thing that nobody's talking about. The only reason you'd refinance at a higher rate is to cash out. So if you have a house that's worth $500,000, when you got your mortgage last time, it was worth $250,000 or $300,000. So you have a $200,000 mortgage on your house, right? Loan to value. Now the house is worth $500,000. Well, you need money. You're out of cash. You need to borrow money. So you bite the bullet and refinance your 4%, 4.5% mortgage at 7% just so you can take out $100,000 to pay your bills because you're running out of cash. The only reason I could see that anybody is refinancing at higher rates is because people are running out of cash and they have to start getting money out of their house. It's going to be a recipe for disaster because if you have a 4% mortgage on $200,000, let's say using our example, your payment's about $1,200. If you have a 7% mortgage on $400,000, your payment's going to be like $3,800. So you're tripling your monthly payment. And if you're already out of cash, adding $2,000 a month to your expenses is not going to get you any more cash. You're just giving away your house to your lenders. That's all you're doing. Housing starts plummet What does that mean? That means new home builders. See the picture of the house here with the house wrap, the Tyvek on it? New home builders are starting to back out of the market. They were the only saving grace for a long time, new home builders. So now the builders are saying, wait a minute, we're seeing maybe we need to be cautious. So they're not building as many new homes. The only place that any inventory was coming into the market, net inventory, was coming from new home construction. The game is over. Sure, there's builders still building stuff, but they're plummeting lowest. Now, these are the housing starts. So what that means is houses that are for sale right now were probably started maybe a year ago, 8 months ago, depending on your municipality. Some places you can start a house and have all your permits, approvals, inspections done in 3 to 6 months. Some places take several years to get from a housing start to a finished home. On average, it's about a year. So housing starts plummeting means a year from now, there will be less new homes on the market. There's already a shortage of houses, even at high interest rates. America's biggest landlords can't find houses to buy. Well, a lot of people don't even agree with this, that corporate landlords, these corporate property owners, should be buying houses. But this proves there's a shortage, because even the people that are paying big bucks, the biggest landlords, fewer properties for sale has slowed Wall Street's home buying. Well, there's your answer. Wall Street's home buying. And this is from the Wall Street Journal, ironically. So the big hedge fund, the companies that are buying up homes, they can't even find houses. It's not just regular Americans who are having trouble buying houses. It's the Wall Street rental giants limiting their ability to grow. At the same time, suburban rents are climbing. So the rents aren't going down. Rents are climbing. The biggest landlords' computers are still poring over listings, scanning for houses they can buy. So they're having trouble at the same time. I know you have an opinion about this. Let us know in the comments what you're thinking. So we're going to switch gears now and go to electric vehicles. Here's the thing. Not many people have electric vehicles at the moment. It's roughly 3 or 4% of the market for new sales. Maybe 7 or 8% of the people have it in their garage, but it's not a huge thing. Not a huge thing. You probably don't have one. Chances are you don't. And even those 5 or 6% of people that have an EV, they probably have a gas car too. It's not probably their primary vehicle. So you probably don't have only an electric vehicle. So you might be thinking, I don't care what happens to EVs. It doesn't affect me. Well, it does affect you. Here's why. There's some details about electric vehicles that are different from gasoline vehicles. It's not the same. They may look the same on the outside. They have 4 wheels, a windshield, windows. Yeah, they look a little more streamlined, and you can almost always tell an EV by looking at it that it's an EV, but it still is a regular car. One of the biggest giveaways is the grill. Anytime you look at a car, if you look at the front grill and there's no hole in the front of the car where there's a grill and an opening, that's an EV. The reason why is because the only reason a gasoline vehicle needs a grill is because there's a radiator behind that grill that helps cool the engine. You cool an engine that's a combustion engine, a gasoline engine, by running water through the engine and then through this radiator that cools it down to keep the engine from overheating. You don't need that on an EV because there's no burning inside the engine. There's no gasoline being burned. So you don't need a grill. The front of the car is rounded over and it's closed off. There might be a couple little holes to get some cooling for brakes, but it's closed off. But there's other differences too that you can't see. One of the differences is the way the cars are built. Tesla pioneered what's called a cast body, which means that instead of having separate metal body panels, it's all cast as a one-piece stamping. Cheaper to build. For an electric vehicle, it's okay to build that way because the battery becomes the structural integrity of the vehicle. The body panels are just really for show. The problem is when you have a cast body, it's impossible to fix. And we've seen the articles. We had a couple videos last month where somebody had a small dent, collision in the back of their car, and it cost $60,000 to fix the car. It was totaled. These cars can't be fixed. It's kind of like your phone. right? If you drop your phone, no one's going to take the time to rebuild the case because it's impossible to fix. That's what's happening with these vehicles. And you might say, well, that doesn't affect me. I don't have an electric vehicle. Well, it does. And here's why. You are buying car insurance on your car. Part of what your insurance covers is if you crash into another vehicle, fixing that other vehicle. So even if your vehicle is cheap to fix, if more and more vehicles on the road are expensive to fix, that gets baked into your insurance premium. It gets factored into your cost, right? Because most of the time, when your insurance company pays a claim, it's for damage you did to the other guy. So as more of these vehicles get on the road, you're going to see things happen like insurance premiums go up. And you're going to see things like repair turnaround times get higher. Electric vehicles are coming. They have kind of did what I call the Cortez burn your ships strategy. The auto manufacturers, mostly because of influence by government agencies, have gone to abandoning gasoline vehicles as a future part of their business. In fact, we did a video 3 years ago where Chrysler at the time fired all of their internal combustion engine engineers that were developing new combustion engines for the future. That doesn't mean they stopped making combustion engines. It means that they weren't building any new versions of them. And you can usually run out the clock for your existing technology, your existing platforms for 4, 5, 6, 7 years. Maybe make a couple updates to it. But they basically told the world, look, we're not doing gas engines anymore because all of our development and R&D for that department is gone, getting rid of it. And that was a few years ago. So they're putting all their eggs in one basket, EVs, and most manufacturers are doing this. But what that means is that whether you like it or not, at some point, could be 2028, 30, 32, whatever it is, there will be either no gasoline vehicles available or very few available, meaning that you're not going to have a choice. And maybe the cars that are available aren't the kind you want. Maybe it's not an SUV. Maybe it's not a sedan. Maybe, right, it's old looking because they're not going to update them. What does it do to values of current gasoline cars? Well, that's tough to say. They could either be worth a lot more because people want them and there's not as many, or they could be worth a lot less because it's hard to get them fixed. One way or another, the invasion of electric vehicles is going to affect you. So start planning for it now. We talked about it before. We recommend putting an EV charger in your garage now because it's pretty cheap to do if you can do it slowly, right? You can buy some wire and run it yourself. You don't have to connect it, which requires an electrician. But if you do a lot of the manual labor of just running the wire, maybe putting in the box for the plug and just leaving it hanging, the next time you have an electrician come to your house for anything, any small thing, hey, while you're here, can you connect this up? And it might be really cheap. It might only charge you $50, $100. Where if you call an electrician to say, install a complete charging system, that could be a couple $1,000 or $1,500. So, and plus there'll be inflation even on the wire. You know, you could maybe buy the wire today for $80 or $90 or $100, depending on your run. You're going to need, 2-gauge wire or aught wire. 3 years from now, that same piece of wire might cost you $150 because copper is going up in cost. So we recommend putting one in. Even if you never get one, it'll add value to your house. So the last subject is one that most consumers aren't really thinking about, and that is cyber attacks, cyber risk, cyber attacks. And in the last week, you probably saw some news about cyber attacks. In effect, you saw that many of the big casinos and hotels were attacked, cyber attacked by hackers, and they shut down the hotels. You couldn't check into your room. Well, behind the scenes, what you're not knowing is there's a lot of companies that are starting to add money to pay for what's called cyber premiums. That's cyber liability insurance. 3/4 of organizations say cyber insurance is required by their board or executives. Required. So companies are starting to put that in their budget. That was something that was not in the budget before. What does that mean? Their costs are going up, which means their prices for whatever they sell has to also go up. Total surplus lines premiums, that's where cyber policies fall into, went up 20% in 22. That's not even counting this year. Here's the casinos. Caesars and MGM boards lose their gamble. They tried to gamble by not having IT people and a lot of advanced risk coverage on their businesses. Well, they lost out because this is costing tens of millions of dollars. Last piece of news is that cyber insurance claims are spiking. So the number of times that insurance is being put in place on businesses and the claims are being filed went up 12% in the first half of 23. And claim severity went up 42%, average loss of $115,000. That means something. That means that more and more claims are hitting for cyber. In fact, on our insurance side, you can see our link below, risk coverage, we expect that in the next 4 or 5 years, cyber attacks will be a much more probable and higher risk for most companies than fire, than your building burning down. It could be higher risk. And almost every business has fire insurance. Maybe a quarter to a third has any kind of cyber insurance. So there's a disconnect there. As a consumer, you might think, well, how does that affect me? These are going to be costs that go into a business that have to be passed along. And some of the procedures, it might be harder to log in to your accounts with some companies because they have to put in security. It might be more difficult to get data from companies because their security requirements are increased. Even if you are a consumer, non-business owner, what are your thoughts on this cyber attack thing? Let us know. Like, I don't care. I don't think it's a problem. I think it's overblown. I think it's exaggerated. Or do you think there's something really going on there with all this cyber talk? I know you have an opinion about that. Let us know in the comments what they are, and we'll see you on the next video.